So, let me ask you something. What if you could make $1 million day trading? I know, it sounds pretty crazy, right? But that is the exact claim from a trader named Ross Cameron. And today, we're going to break down exactly how he says he pulled it off. Yeah, you heard that right. $1 million. I mean, that's a life-changing amount of money for just about anyone. But it's not even the amount that's the most shocking part. It's how fast he did it. The time frame here, well, it's what makes this whole thing seem, almost impossible. Get this, just 51 trading days. 51. To put that into perspective for you, that's an average of nearly $20,000 every single day. So, okay, that brings us to the big question, right? How? What's the secret? What's the strategy? Well, according to the source material, this isn't about luck. It's a repeatable system. So let's pull it apart and deconstruct that blueprint together. All right, so here's how we're going to crack this thing open. First up, the foundation, managing risk. Then we're going to go on the hunt for the right stocks. After that, we'll look at the exact trigger, when to buy. And finally, the secret sauce, how to scale up smartly. Okay, first things first. And this is probably the most important part of the whole thing. Before you even think about making a single dollar, you have to master risk. The source is super clear on this. This is the absolute bedrock of the entire strategy. And at the very core of managing risk is a pretty simple rule, actually. It's called the profit to loss ratio. The idea is you only take a trade if your potential profit is at least double your potential loss. That 2-to-1 ratio, that's the magic number. And here's why that rule is so powerful. Check out the math. If you're risking $1 to make $1, that's a 1-to-1 ratio. You have to be right half the time, just to break even, right? Makes sense. But look what happens with the 2-to-1 ratio. Suddenly, your break-even point drops all the way down to 33%. Think about that. You can be flat out wrong 2 out of every 3 times and still not lose money. That changes everything. This all leads to this really powerful, kind of weird idea. The goal isn't to never lose. In fact, it's the opposite. It's to get good at losing. By cutting your losses super fast without getting emotional about it, you protect your money for the trades that are actually going to make you a winner. All right, so we've got our risk managed. The obvious next question is, where do we find these stocks to trade? And this is not about throwing darts at a stock chart, okay? The whole strategy relies on a really strict filtering process. It's like panning for gold. You sift through thousands and thousands of stocks to find just a tiny handful, maybe 3 to 5, that have the potential for those really explosive moves. And here it is, the filter itself. It's a 5-point checklist. First, you need high relative volume. That just means way more trading activity than usual, a sign that a lot of people are interested. Second, the stock is gapping up. Its price is already jumping before the market even opens. Third, it's in a price sweet spot between $2 and $20. Fourth, it has a low float. Now that means there's a limited supply of shares available, which can make it move really fast. And finally, number 5, there has to be a news catalyst, a real-world reason for all this excitement. A stock has to check every single one of these boxes to even be considered. Okay, so let's recap. You've got your risk rules, you've found a stock that passes all 5 checks. So now what? When do you actually hit the buy button? Well, the answer comes down to one specific chart pattern. It's called a bull flag, and you can think of it in 3 simple steps. First, you get the spike. That's a sharp, sudden price jump on high volume. Imagine a flagpole. Then comes the pause. The stock pulls back just a little bit. That's the flag itself. Now, this is important. You don't just buy here. The crucial third step is the entry. You buy the second the price starts moving up again and breaks past the high point of that little pause. That's your signal that the next wave of buyers is rushing in. So now we have the what and the when. We've got the rules for risk, finding stocks, and pulling the trigger. But, just knowing the rules, that's the easy part. The really hard part is doing it over and over again, day after day, without letting your emotions get the best of you and blow up your account. And that's where this next idea, scaling smartly, comes in. I mean, this is the question that keeps every trader up at night, right? How do you stay consistent without blowing up? We all know it only takes one bad day, one dumb emotional decision to wipe out weeks of hard work. And the source suggests the key isn't just in the strategy itself, but in how you begin your day. And the rule's actually pretty simple. You don't just dive into the deep end. You test the waters first. You start your day with really small trades. They call them quarter-size trades. The whole point is to build up a small profit cushion. Because look, if you can't make money with a small position, what makes you think you'll make money with a big one? This little trick helps you avoid a big loss right away that can send you into that downward spiral of, revenge trading. And this right here, this highlights a huge difference in mindset. The source points out that beginners, what do? They add more money to their losing trades. They average down, hoping it'll come back. A pro does the exact opposite. They add to their winning trades. They press their advantage when things are going their way, and they cut the losers without a second thought. It really all boils down to this one simple philosophy: survive till you thrive. The goal, especially in the beginning, isn't about getting rich tomorrow. It's just about staying in the game. You survive long enough to get the experience, to build that intuition, and then you can thrive. So there you have it. The blueprint seems pretty clear, right? Manage risk, find the right stocks, use the bull flag trigger, and scale up smartly. Sounds straightforward. But that begs the question, if it's so simple, why isn't everybody a millionaire trader? And that brings us to the final and maybe the most crucial point of all. The source argues that it's not the strategy that fails people, it's the lack of discipline. The real battle isn't against the stock market, it's against yourself. It's against your own fear, your own greed, your own frustration. See, knowing the rules is one thing, but having the mental toughness, the discipline, to follow them perfectly, day in and day out, well, that's what separates the amateurs from the pros.